Good evening, everyone, and good morning to Professor Penman. All praise due to Almighty Allah that grant us this great opportunity to meet online and to learn together from Professor Penman this evening. So I'm Novrys Suhardianto, the host of this event this evening. So nice to meet you, Professor Penman. How are you there?
I'm there. I'm very pleased to meet you all too.
So I hope we don't make you wake up too early this morning in New York.
No, it's okay.
So, okay, yeah. So is Columbia University still locked down, or you can manage to have half offline work?
We're opening up now. We intend in the fall in September to be completely open. We still have regular testing and so on, but it's gradually opening up at Columbia.
Oh, okay. So yeah, thanks for your kindness, Professor Penman. You give us a chance to learn from you something new, something very important for us. So this guest lecture is proudly presented by Accounting Department of Faculty of Economics and Business, Airlangga University, and Airlangga University is actually third largest university in Indonesia. And this guest lecture is one of series guest lecture we're gonna have this year. As you may see on screen, last time we will have a very soon guest lecture after this in 31st of May. So thank you very much for all committee that prepared this event, especially our head of department. We have here Dr. Vivek Suprativi and Dr. Nadia as the Secretary of Department. And we also have Dean Faculty of Economics, Professor Dian. I guess she is here now. And so to begin, let's listen to some words from the Dean of Faculty of Economics and Business, Professor Dian. So Bu Dian,
yes.
If you can hear me, please, time is yours.
Yeah, thank you. Good evening, Mr. Novrys.
Good evening. Yeah.
Okay. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Praise be to Allah God Almighty, who for His grace we can attend this evening online lecture. I would like to convey my sincere gratitude to our honored guest, Professor Penman from Columbia University. Hello, Prof.
Hello.
How are you?
I'm very well, Dean. Thank you very much, and thank you for this opportunity to join you.
Yes, nice to meet you. Thank you. I would like also to thank Dr. Novrys for acting as the moderator for this event. Distinguished speaker, head of accounting department, Bu Wiwi and Bu Nadia, and ladies and gentlemen. One of the long occurring debate regarding financial accounting topic is the whether to have a bigger emphasis on balance sheet or income statement. Professor Penman is one of the leading professor in regard of financial accounting conceptual framework and this key question in particular. His paper discuss a method of conveying information about uncertainty with involve a balance sheet recognition and measurement in such a way that has considered the consequence of
Well, I think she is lagging.
I think the signal is weak. Maybe you can contact him, Pak Novrys.
Yeah. Just like it. Oh, she's gone. It's part of uncertainty of using this Zoom. Okay.
Yes.
Yeah, she's gone. Okay. Yeah, she's gone. My God, 19, 19 is gone. But anyway, I think she tried to welcome you, Professor Penman, and all participants, and also she appreciated your paper, which is about uncertainty, and you try to incorporate uncertainty into accounting concept. Okay, so after having that short speech from Dean, but unfortunately the signal is not good there. So before we listen to Professor Penman, let me introduce a little bit about Professor Penman, and I think it's not necessary because you are very famous. So Professor Penman is a full professor, a George Ome professor from Graduate School of Business, Columbia University, and he also co-director of Center for Excellence in Accounting and Security Analysis, and director of the Master Program in Accounting and Fundamental Analysis. So Professor Penman got his master degree and Ph.D. from University of Chicago, and he had a lot of paper. He has a lot of paper, and the one that he want to talk about is just published in 2020, moving the conceptual framework forward, accounting for uncertainty. And Professor Penman got elected to the Accounting Hall of Fame in 2019, and in 2020, Professor Penman was elected to the Australian Accounting Hall of Fame. So I think it described the most famous university in Colombia, I think. And we have little thing about the rules, particularly about Q&A. So please stay muted until call upon for the audience, and turn on camera and use Zoom virtual background. I already posted on chat, so please check the chat room, and use Slido or simply Slido to type your questions there, and I will raise the question. I will read the questions to Professor Penman after his presentation. So just visit slide 2 and enter the code number GL01. So I think that's all for the introduction and for the rules of this guest lecture. Now it's your time, Prof. Penman. So you have around 45 to 60 minutes presentation, then we're gonna have around 30 minutes for Q&A. So please, and time is yours now. If you want to share, you can do the share screen.
Okay, thank you very much for that kind introduction, and thank you very much for this opportunity to join you there far away from me in Indonesia. One of the benefits of, I guess, the pandemic is we become a little bit more connected, because we've all got used to this Zoom. Zoom can be a little bit annoying at times, but it certainly has been a facility for us to join as colleagues worldwide on research and other issues. So thank you very much for the opportunity to join you today. I have my present. Can you confirm that you can see that?
Yes, very clear.
Yes, yeah. Very good. Okay. As the talk has been titled, it's accounting for uncertainty, which may be somewhat of a mysterious heading, which I want to explain. A number of you have, one of my papers that has been headlined for this talk is the paper on moving the conceptual framework forward, which also deals with uncertainty. And I will be coming to that paper at the end of the presentation, but much of what I'll do is sort of give you the thinking behind the paper to build up to that paper. That paper is very much an accounting policy paper, particularly on how on asset recognition and particularly on intangible assets. But I think it needs a lot of background to indicate the thinking before it and how the accounting for uncertainty can work. I will just ask one thing of you. I'm not sure if I tend to talk a little too fast at times. Okay, so Mr. Chairman, if in fact you think I'm talking too fast for the audience, please let me know.
Okay.
I will try to slow down.
Okay, fine.
Okay, so let's get going. Let me remind you of the one of the objectives of the International Accounting Standards Board and indeed the Financial Accounting Standards Board in the US. They have two main objectives. One is to provide information to investors, and the other is information about the stewardship of management in serving those investors. And one phrase in the conceptual framework sort of grabs my attention, because it says that the objective of financial reporting is to provide information about future cash flows and about, quote, the amount, timing, and uncertainty of future cash flows. And you'll notice that I have italicized the word uncertainty here clearly, because this is what this is about. So the question is, how do you do accounting that actually reports on the uncertainty of future cash flows? Typically, we think of accounting as giving us some information about the expected future cash flows, not about their uncertainty. But as you come to think about it, you can see that embedded in accounting is very much principles that actually inform about the uncertainty of the cash flows. And that's what accounting I'm going to talk about. And with that accounting, then we'll lead into the policy aspects of the conceptual framework in that moving the conceptual framework forward paper. Let me just ask, are you hearing me? Are you hearing me clearly?
Yes.
Very clear.
Wonderful. Okay, so we're going to talk about accounting principles that give information about the uncertainty of future cash flows. My work largely has been on accounting for investors. As indicated in the introduction, I am the director of a program in fundamental analysis and accounting at Columbia, which builds upon the historic emphasis at Columbia on value investing, began by people like Benjamin Graham, David Dodd, and of course with illustrious graduates such as Warren Buffett. But my aspect of it has been to actually join value investing much closer than accounting. And investing, of course, it's a question of information about future cash flows to the investors, whether they be debt investors or equity investors, but of course the uncertainty about those cash flows. And so we want to talk first of all about accounting principles that might actually provide information about that uncertainty. As it turns out, a lot of it is actually already embedded in IFRS and in US GAAP accounting. Okay, so let me start with just a little bit of a personal experience. I was an undergraduate at the University of Queensland in Australia, which is actually you're a lot closer to now than I am actually, physically. And I took a number of accounting courses as part of my commerce and economics degree. And it was there, in fact, that I was really grabbed by the ideas behind accounting. so I took the first accounting course, which is appropriately was called the Principles of Accounting. And the professor came into the classroom, the first class, and he said, "Now listen, when you keep your accounts for your tennis club, you use a thing called cash accounting. And all that does is has a statement which has cash receipts and cash disbursements as the flow statement, but it doesn't really have a balance sheet." Well, it does have a balance sheet, but the only account on that balance sheet is the cash account. So it's really accounting for flows into and out of the cash account. And that used extensively, of course, for non-profit organizations, even for governments. The US government buys an aircraft carrier, it treats as an expense and outflow immediately. It doesn't uses cash accounting. But he then said, listen, when we account for businesses, we don't use a cash accounting, we use a thing called accrual accounting, which differs from cash accounting. He said, understand that over the life of a business, the total earnings for the firm equals the total cash flows they generate. But in any individual period, the cash flows, the earnings recognized under accrual accounting can differ from the cash flows. And he said, for business, this is better accounting. He wasn't quite clear about why it's better accounting, I guess, but it's supposed to be better accounting. And then he came to the front and said, maybe this was the second lecture. He came and said, what is the accounting principle that governs accrual accounting for the recognition of earnings? And here he stated it. Under uncertainty, it's in red on the screen, under uncertainty, earnings are not recognized until uncertainty has largely been resolved. Before that point, the accountant says, I'm not going to recognize earnings. I'm going to delay the recognition of earnings until uncertainty has been resolved. You as an investor may anticipate expected earnings or expected cash flow, and that can be in the price, in the stock price. But we as accountants are not going to recognize those earnings until they get realization. That is, until that point, the earnings are deemed to be at risk. I sort of forgot about this for many, many years, and it came back to me about, or maybe 15 years ago, and really has been the basis of much of my research for the last several years, which has been on this topic of accounting for uncertainty. He then said, look, how do we implement this? Well, there are two aspects of the implementation. The first one, of course, earnings are revenues minus expenses in the income statement or the profit and loss statement. He said, look, first of all, for the revenue, the top line number, we only recognize earnings when it's realized. We have a realization principle. And to put it in a modern context, under the FASB and IFRS 15, the criteria are very explicit. You cannot recognize it until there's been a satisfaction of a contract. Both the buyer and the seller, the customer and the supplier have to complete their obligations under a contract. That is the whole economic aspect has been completed. And secondly, receipt of cash is highly certain. But you cannot recognize revenue at this point. Put it more crudely, you've got to get a customer. You have to satisfy your obligations as a firm. You have to get a customer, and the customer has to show a fairly high probability that he or she is going to pay. And then we'll book a receivable, an accounts receivable. But even then, we'll say, listen, there's a probability, still some remaining probability that the customer will not pay. We'll discount the receivable for bad debts, is expected bad debts, to bring it to a cash equivalent. And so you see very much the rule is there, you cannot recognize this revenue until you get the resolution of uncertainty. Even if you've got orders in the order book, confirmed orders in the order book, you cannot recognize that until there's been a completed execution. So until that point, you as an investor can anticipate that you're going to have a lot of future customers. You're free to on a startup firm to speculate there's going to be a lot of future customers, and you should appropriately. But be reminded, the accounting is telling you that value is still at risk until you get the realization. So then the professor then said, listen, what we do then is we take the revenues and then we match expenses that are incurred to generate the revenue. That's called the matching principle. And you'll see it in case of inventory. We don't use cash accounting for inventory. If we spend cash on inventory, put it in the balance sheet, and we only bring it to the income statement as cost of goods sold when, in fact, you get the customer and you get a matching of the inventory cost to the revenues. And that gives you the added value from the trading from customers. And that's what we do in the income statement. However, I came to realize that he was wrong on this. Actually, a lot of our accounting resolves mismatching when it comes to expenses. And the guiding principle, which again is embedded in the conceptual framework, it's just embedded in many accounting standards, is that if we make investments which are particularly risky, we do not put them on the income statement. We expense them immediately. And that's a mismatching. An investment in R&D is an investment to get future revenues. It's not at a cost to generate current revenues. It's mismatching. And so we, in our accounting principles, we very explicitly have mismatching. That's in the conceptual framework, where actually the conceptual framework says an asset is something with reduced future benefits, but when you get to recognition, it says, hold it. If the outcome is particularly uncertain, you can't book the asset. You've got to expense it to the income statement. Under FASB statement number 2, we expense all R&D in research and development in the US. Why? Because it says because of the uncertainty of the future benefits. We're not sure the R&D is going to be successful. In IAS 38, which deals with R&D, of course, it separates R from D. D can be capitalized, but R, research, has got to be expense. And the criterion there is very clear. Because it's a difference in the probability of future benefits. Once you get to the development stage, you're more clear, more certain, less uncertain about the outcome. Even in IAS 16 on property, plant, and equipment, which typically is booked to the income statement, fixed assets, it says requires that the benefits from the asset are probable before it can be booked, and so on and so forth. So this is very much embedded. And what is this? This is a regulated, prescripted mismatching. We don't do mismatching. We, by design, we mismatch. Now, why do we do this? Well, in the case of revenue, it's a reaction to uncertainty. In this case, it's also a reaction to the uncertainty of future benefits or the probability of future economic benefits under IAS 38. So we actually implement this uncertainty accounting both on the revenue side and the expense side. And I think I can go as far as say is the guiding principle for recognizing revenues and expense is a reaction to uncertainty. In investment, we call that risk, and there is a technical difference between a risk and uncertainty. But for the purpose of this talk, we'll talk about risk and uncertainty as being the same thing. So that's very much built in. And so you see in our standard accounting, there is this accounting for uncertainty. In fact, it is uncertainty that drives the accounting for recognizing revenue expenses, for recognizing earnings. And as earnings are added to the balance sheet, it's actually the accounting for adding to the balance sheet. And so if anyone who's an accountant says this is not so, please let me know, because I think it's quite explicit. Okay. Now, I should say, there's a departure from this in the more modern accounting which has been proposed, which is fair value accounting. Okay. So here we're talking about what would be referred to as historical cost accounting, traditional historical cost accounting, which I prefer to call refer to as deferred recognition accounting. But fair value accounting is very different. Fair value accounting, or mark-to-market accounting, says, let me think about what all the expected future cash flows are. They're going to come from customers. Let me take the present value and let me put it in the balance sheet. That takes away all this accounting. So that's a point that really divides fair value accounting from historical cost accounting. Fair value accounting gives a balance sheet, which is a very risky balance sheet. You can put those assets in the balance sheet, but they can explode on you. It actually turns out that this accounting was actually the distinction in this accounting was the accounting which prompted the whole value investing tradition with Benjamin Graham in the early 1930s. In the 1920s, boom times, accountants wrote up assets to their in a style of fair value accounting. In one day, on October 1929, the whole thing crashed and all these assets values went away. The value investing tradition, the fundamental investing tradition, which actually rolls over to accounting prescription, was as follows. Benjamin Graham said, no more water in the balance sheet. John Maynard Keynes had the same experience. He lost a lot of money in October 1929, and he, after that, became a firm fundamental investor with the mantra, no more water in the balance sheet. Water can evaporate. We saw that in 2007, where banks had fair value mortgages in their balance sheet, pretending they had the value, but the whole thing vaporized in the as we saw the crash in real estate prices. So I just wanted to indicate that this issue is at the core of this this is at the core of the issue of whether we want to have fair value accounting and historical cost accounting, and at the center of this is how you handle uncertainty. How does the accountant handle uncertainty? Okay. So here are the examples. Here are the examples of the expense investments. R&D, of course. Advertising. Advertising can be for generating current revenues, but it can also be for generating future customers and future revenues. Investment in human capital, building up your workforce. Software investment. Most software investments expense immediately until they get to technical feasibility. Expenses on customer loyalty programs. Distribution systems, getting your good investment and getting your goods onto into Walmart and the big retail chains. Supply chains development. Starbucks investing to get the coffee supply chains from South America, from Indonesia, to developing those supply chains. Building organizational structure. These are all expensed. In fact, it's said, and I think it's right, in the modern corporation, the investment is more in these so-called intangible assets that they are intangible assets. And those are mostly, under the current accounting, those are mostly expense. Now, the accountant does this, but you say, well, this is just the silly accountants. being too conservative. And people who advocate fair value accounting would say, yes, this is just, this conservative is not good accounting. In fact, they revised the conceptual framework to take conservatism out of the conceptual paper, and they talk now about neutral accounting, okay, rather than conservative accounting. The question for investor is this a price risk? And for those of you who have studied investing, we understand basic finance that risk, the only risk that is price risk is risk that cannot be diversified away in a portfolio. This is Markowitz. This is the capital asset pricing model. It says only the risk that cannot be diversified away in a portfolio is price. Other risk is non-systematic risk is not price. And so a very important question for investors is whether this accounting tells you about your systematic risk. And I refer you to that to a technical paper, a theoretical paper by myself and Chao Zhong at Berkeley, published last year, which actually makes the connection. That it connects both revenue recognition and conservative accounting for investment to the discount factor in a general no arbitrage asset pricing model, okay? Now that's a little bit of technical language here, but actually I'm very proud of this paper because it actually formally links what the accountants are doing to what investors are interested in theory. That is price risk. Okay, so I think I missed a slide here. No, did I miss the slide? Okay, no. Okay, so the accounting effect, of course, is you have mismatching. Instead of matching expenses to current revenues, you're having expenses, investments incurred to get general revenue, future revenues matched to current revenues. This is mismatching, and so this is something we've got to be very careful of when we evaluate an income statement. The notion then that we take earnings as a sufficient measure of how the firm is doing is not a good measure. If you want to do financial statement analysis, if you want to understand what the accounting is telling you as investment, you really need to understand, hey, what is coming from current revenues, the income from current revenues versus that which is corrupting this, if I can use that word, because of this mismatching, okay? In my mind, it's a very important issue in fundamental analysis. But let's recognize it's a mismatching, and mismatching is considered to be bad, okay? But just to emphasize the point, there's method in the madness here, okay? What the accountants are doing. They're reacting to uncertainty. The proposal then is a very common proposal amongst practitioners, amongst consulting firms, and indeed amongst academics. In some of the papers I've listed, only the few of the papers I've listed on the slide here, my good colleague Baruch Lev down the road here at NYU, New York University, is very much a proponent of this. What we should do is actually, the accountants are really mismatching here. They're messing up the income statement. You should, in fact, capitalize the investments and book them to the balance sheet, just as you do with tangible assets. So why should there be any difference between an intangible asset and a tangible asset? Both should be booked to the balance sheet. And that's the proposal. The objection to that is, if you do that, you're going to lose this information about the different degrees of uncertainty that is going to, that the accountants are actually providing you at the moment. You book inventory to the balance sheet because probably you can sell it tomorrow or in the near future. You book property, plant, and investment to the balance sheet because it's producing a known inventory, which is known to be able to demand from revenue from customers that you probably can sell tomorrow. And by the way, if that's not the case, we write the asset down, we impair it. If in fact it's not going to deliver its carrying values from selling from customers in the future. So you lose that information. And so you come to, let's say, think about R&D. You're doing R&D, you're a startup biotech. You're looking for a cure for a particular type of cancer. And there's a lot of biotechs doing this. Let's say it only has 5% probability of success. Okay. Are you going to put it on the balance sheet along with property, plant and equipment, fixed assets and inventory and pretend you have collateral when there's only a 5% probability of success? The accountant says no. And the accountant says, hey, listen, this is my speaking, not the accountants generally. If it's only a 5% probability of success, if you book it to the balance sheet, there's a 95% probability that you're going to have an impairment next year or 2 years or 3 years' time. Now, if you expect to have an impairment, rational expectations say that you should take the impairment now down, that you shouldn't leave assets on the balance sheet where you have an expected impairment. Actually, that's what we do with assets on the balance sheet. We say, look, it's probable here that the inventory, the fixed assets are going to generate earnings, but any indication that that's not going to be the case, that we're going to have a loss, we impair them now. We write them down. Lower of cost or market rule for inventories, and then write downs of fixed assets. If you have a 95%, you're holding a fixed asset, a plant, and there's a 95% probability that you're not going to get the customers, you write it down. And so in consistency, that should be the case with R&D, to put it on the balance sheet and pretend you have an asset that you can lend against would seem to be mixing up apples and oranges. Or I should say apples and grapefruit, which is much more tart to the taste. Okay, so that's sort of the point here, one of the points here. However, there's another objection. As you can see now, we are beginning to move on to accounting policy and how we might account for these intangible assets. There's a further objection. When you capitalize an asset to the balance sheet, you're not done. You have the remaining problem of amortizing the asset to the income statement against the projected revenues. An amortization schedule can be established, or a schedule, a rule for taking the asset cost to the income statement. Now, in inventory, we handle that, we think, quite well. The inventory goes to the balance sheet, but when it goes out to the door to a customer, we take it from the balance sheet at cost to the income statement. Okay, and we have pretty good matching. We feel that we can actually do good matching with inventory. And typically we do. There are some issues about absorption costing versus variable costing for inventory, LIFO versus FIFO, and so on. But that's so we feel we can do that. With property, plant, and equipment, we have a long history that says, based on evidence, we can estimate useful lives pretty well. And in fact, we don't see large gains and losses on the disposal of fixed assets, which of course are always gains and losses on the disposal of fixed assets are just the correction for incorrect depreciation in the past. We don't see that. So it seems to work. Now, of course, depreciation is always open to challenge, whether it's a good depreciation and so on. So there's still an accounting issue there. But when it comes to an asset where there is, we're uncertain about the revenues, Maybe there's no revenues yet. How do we establish an amortization schedule? Under uncertainty, and let me stress those words again, under uncertainty, it's going to be, we're going to introduce mismatching. That ex-ante amortization schedule is going to create mismatching, okay? And what does that do? Well, it gives you mismatching. And so, and if in fact that matching is bad, just like you have bad depreciation, that messes up the income statement. That gives you fuzzy income as a measure of the value you're earning from customers, the value added from earning from customers. You destroy the information in the income statement. So it's not just a simple matter of putting assets on the balance sheet, because, and I think this is what's missing from a lot of proposals to capitalize these very uncertain assets to the balance sheet. The focus on the balance sheet. But under double entry accounting, there's not only a balance sheet, there's an income statement. And anything you do in the income statement, you've got to examine what the consequences are going to be for the balance sheet. And that's a matter of whether you're going to get a good measure of earnings or profit and loss. So that is a very important issue. So coming back to our R&D, excuse me, coming back to our R&D, a firm capitalized R&D for this drug, which only has a 5% probability. It becomes an asset. What's the amortization schedule? There's no product yet. There's no revenue. And there may not be. What's the amortization schedule? It will have considerable error under uncertainty, because of the uncertainty, resulting in mismatching and unaffirmative mismatching. And indeed, as we saw before, we are possibly going to get further mismatching because we're going to have impairments. And impairment is a mismatching also. It says I shouldn't have booked this asset to the balance sheet. The accounting where you do the mismatching up front as expensing the uncertain investment immediately is very clear. I'm not going to put on the balance sheet and create mismatching later and a bad income statement later. I'm going to tell you straight up front, this actually is an asset that I'm going to avoid that subsequent mismatching by mismatching now. Now, I don't claim that GAAP or US GAAP or IFRS does this well. I think that's a huge research area to the extent that you get good depreciation schedules, you get good amortization schedules, okay? And to the extent to which you actually capitalize or you don't. IAS 38, where you capitalize R, but you don't capitalize D development, seems to me have an element of insight into it that maybe some investment, some R&D you can put on the balance sheet because you got to the development stage and you can project the future revenues against which you can amortize the investment, okay? Yes, you've got the drug, you've got the patent, it's a 15-year patent, you've got an estimated life, okay? Maybe you can go ahead. But this is a very interesting area to the extent to which maybe the accountants are too conservative. I'm not claiming that GAAP and IFRS work perfectly in this scribe. All I'm emphasizing here is principle, okay? An accounting principle, which is accounting principle for handling uncertainty. Excuse me. So there is a misconception, as I've said. Recognizing assets on the balance sheet is seen as getting a better balance sheet. Oh, they say. Assets are missing from the balance sheet. You accountants, you're making a big mistake. You haven't got assets on the balance sheet. Well, that's a point. Okay. And accrual accounting that says we don't want cash account, we just don't want a cash balance sheet, we want inventory on the balance sheet, is considered to be better accounting. But There's also an income statement. I think back to the late 1990s, which some of you may remember, where we had a huge bubble with all these internet companies. And the scream that was going out, particularly for investors, including some academics, is saying, look at the price of these new internet companies. The price is a huge multiple, 20, 30 times book value. The market's putting a large value on these new startup internet companies. You've got to put the asset on the balance sheet. That, by the way, violates a very basic rule of fundamental analysis. You don't look to prices to actually determine your accounting, because the role of accounting is to you get information that challenges prices, so you understand as an investor whether it's a good price to buy it or not. But the accountants at the time said, no, we're going to wait the realization principle. And for most companies, the accountant turned out to be right. 80, 90% of those internet companies went out of business. And if you understood the accounting and said, look, these are companies in this bubble that the market's pricing a lot of expected earnings in, but the accountant's reporting losses every year, you say, well, maybe the accountants have got it straight. If they're earning just report losses, maybe there's risk here. You see, you get the point. But the point is, accounting doesn't just involve a balance sheet. It involves an income statement. And whenever you have an accounting policy prescription, it's not a matter of just getting the balance sheet right. It's also the consequence of the income statement. And I think that's a key issue in policy issues surrounding accounting. But there's a tension, okay, as we see. Expensing investment creates mismatching now. All those investments, which are very common in the modern non-tangible asset firm, okay? The firms are the US firms where they don't have much intangible assets. It's all in, they've outsourced all the manufacturing to Taiwan, to Chengdu, to Indonesia. The investment is in their brands, in their R&D, okay? That gives you mismatching, but capitalizing can create mismatching. It can destroy your income statement, give you fuzzy earnings, because the way you match, you do the mismatching. An important point to recognize is, though my professor taught me that what we do is we match expenses to revenues to get a good measure of value added from trading with customers, that matching only works perfectly under certainty. You know the revenues for sure, you know which period the revenues are going to come, and you can run the amortizations appropriately. We can do that with inventory, with our cost of goods sold accounting. But under uncertainty, mismatching is inevitable. And it's a question of how you want to do your mismatching. And one way, which is accounting for uncertainty, says, look, mismatch now. Get it clearly up there. Now, I should say another issue here, of course, is disclosure. I don't think GAAP and IFRS are particularly clear about sorting out expenses in the income statement, which are expenses to get current revenues and expenses to actually generate future revenues, investments. A lot of it's in selling, general administrative expenses, and that covers a multitude of sins. It buries a lot of investments, and we're not told about it, which I think is actually a real problem with income statements under GAAP and IFRS. So that's the tension here. And so we come to the paper. As I said, this has all been set up to explain the paper, which a number of you I know have been interested in, accounting policy paper, which is the Barker and Penman paper on moving the conceptual framework forward. And underlying that paper is the point that the conceptual framework has typically carried a focus on a balance sheet approach, okay? It's based upon recognizing assets and liabilities. And it says, at least implicitly and explicitly, in fact, if you get the assets and liabilities, income or earnings just drops out, because earnings are just the changes in the assets and the liabilities under double entry accounting. And there's little explicit accounting for the income statement, although they do bring in revenue recognition, it turns out. But the point of this paper is, listen, you just can't think about asset recognition from a balance sheet point of view. You've got to think about it from the income statement. And so what comes up is a basic principle for recognizing assets in the balance sheet. Excuse me. It's on the screen here in red, but you know what it is, because we've just done all the setup in this talk to this point. Under uncertainty, book an asset to the balance sheet if an evidence-based ex-ante amortization scheme can be established with minimal mismatching error in the future. Don't destroy the income statement. If you can get a good income statement out of it, then you capitalize it. Otherwise, no. That is not quite operational, but I think the evidence base indicates to it. You know, with fixed assets, property, plant, and equipment, we have evidence that it works pretty well. There are exceptions. Okay. Inventory, it works well. In fact, in that paper, we distinguished between different types of matching. We talk about type 1 matching, which is the inventory matching, where you can actually do it very deliberately when you make a sale to get your cost of goods sold. We talk about type 2 matching, which is the property, plant, and equipment. But then we talk about a type 3 and type 4 matching, which involves these cases where, hey, there's mismatching error. And the whole idea is to preserve the income statement. You say, well, you don't have the asset on the balance sheet. Well, you put it on the balance sheet. Why do you want the balance sheet? Do you want it as collateral for debt? Well, if you've got a R&D, which is only a 5% probability of payoff, that's not collateral. You want to calculate a debt to asset ratio based on a 5% probability that the R&D is going to generate anything. So actually, I think it's actually consistent with good balance sheet accounting too, at least from the point of debt holders and the calculating the leverage and the debt to asset ratio. And so that's the basic principle there. The paper is, for those of you who read the paper or want to read the paper, it's quite a bit of discourse about the background here, the historical evolution of accounting, and an implicit critique of the conceptual framework which focuses, we feel, too much on the balance sheet. No, it's not the case that you recognize assets and liabilities and the income statement falls out. No, you have to think about the accounting for the income statement. And if you think about the accounting for the balance sheet, it has consequences of the income statement. After all, that's double entry. We just don't have a balance sheet. Double entry accounting gives us both. And always what you do on the balance sheet affects the earnings and vice versa. So that's the policy prescription in that paper. Now there's a subsequent paper by again Barker, Richard Barker, who's at Oxford University in the UK, myself, Andrew Leonard, who was for a number of years was on the Financial Reporting Council in London, the UK, just recently retired, and Alan Cheshire, a New Zealander who was actually head of research at the ISB for a number of years, and now is like the lead technical guru at Deloitte in London, and that's forthcoming. It's on SSRN if you want to look at it, which takes us a little further. Okay, and one of the refinements here, it lays out more of the background which I've had given to you in my talk here. It has a refinement called conditional capitalization. It says this: listen, if you've got these uncertain investments where you're not sure of payoffs, outcomes are uncertain, you expense them immediately. Please put it in a separate part of the income statement. Don't aggregate it all with SG&A, okay? Separate out matched expenses from mismatched expenses. So the analyst, so the investor can clearly see this as investment, okay? However, it says, if and when the uncertainty is resolved, that is, you get to a stage where the R&D looks like it's paying off. You've got a drug, you've got a patent, you've got government approval through phase 1, phase 2, phase 3 testing, okay? You got the doctors interested. Then maybe you should capitalize it. And when that's going to be? Well, according to the Barker and Penman paper, that's going to be when you have an ex-ante amortization schedule that can be can work and that doesn't give you too much mismatching. Okay, at that point, reverse all the costs you expended on the R&D and book it to the balance sheet. Now you have an asset much more like property, plant, and equipment, where the uncertainty has been reduced. Okay, so what's going to happen? That's going to be a credit to the income statement. And what's that going to be? That's going to be a gain on the resolution of uncertainty. Hey, folks, your R&D was successful. You now have an asset, which you can treat as collateral. And you can have this account in the income statement, which is charged with these uncertain mismatch investment, but which is then credited if in fact you get the resolution of the uncertainty. And therefore the balance of this account reports the extent to which the firm is able to develop successful R&D projects or successful advertising, brand building projects, which is very informative. It gives you the extent to which the firm can handle risk and get the resolution of risk and be successful in handling risk. So I think that's a nice idea. Okay, and actually we presented this paper at the IFRS forum last November, I think it was, and the IFRS are particularly interested in this. I'm particularly a couple of the board members are very interested in this. I don't think it's going to go anywhere because they're so slow in doing anything, but and particularly anything radical like this. But I propose that we approach this as a way of doing it, which it's not just a compromise. It's an idea of accounting for uncertainty. It's refinement on accounting for uncertainty. If you get the resolution of uncertainty, where now the uncertainty has been much more reduced, hey, you can put on the balance sheet. Okay, I'm going to close there with just a, we're going on up to our 60 minutes here. I'm going to close just a few empirical analysis. Okay, we can mutter. We can go on about accounting prescriptions, but it's always very helpful to have empirical analysis. My work has largely been developing this accounting for uncertainty, but also conducting a lot of empirical analysis. I'm just going to refer to a couple of papers here, but I have a stream of papers. If you go and look at my CV, you'll see those papers. And they're all based on this accounting for uncertainty, but with the emphasis on the empirical validation of it. Okay, does it pick up risk? Is it priced? Is this accounting priced as if it conveys risk to the investor or uncertainty? There's that theoretical paper in the Journal of Accounting and Economics I referred to. It says in theory it does, but the validation is a scientific method. We just don't have theory. We also have empirical validation. A number of my papers deal with that empirical validation. I'm just going to report to a couple of them. This paper is by Owen Penman. It's a fairly recent paper. O is a former Ph.D. student now in a university in Korea, and he developed some specifications to test this. Okay. And the specifications actually deal with regressions where you have the price of the enterprise or the price of the net operating assets on the left side, the price changes, or the returns to the price changes, the net operating assets on the left-hand side. And you ask what explains it. Those of you familiar with capital markets research will be familiar with these types of regressions, but this is one that's particularly tailored to get to the insight of the issues. The interesting variables on this to take note of is I, which is investment book to the balance sheet. Okay, there you see. Then there is R&D. There's advertising, and I've got SG&A because SG&A, selling general administrative expenses, has a lot of these expense investments. And here are the results. I refer you to the paper if you want to go in more detail. Investment book to the balance sheet. That is the I here for the red I. The coefficient comes up from an extensive amount of data, US data, as being 1.22. Okay, that says that every dollar investment that the accountant books to the balance sheet, the market values, the stock market values at $1.22. That makes a lot of sense. That on average, investment is positive MPV value. It's worth more than its cost. And the market says actually on average it's 22 cents more per dollar investment, okay? And when you actually then look at that T statistic, which is large, when the T statistic is estimated relative to 0, when you estimate it relative to 1, it's also significant. The market is significantly adding value. Okay. Now you go to the expensed R&D, and you see that actually it's priced with a positive coefficient. It has a significant T statistic. It's 0.65. Okay, so the market treats the R&D as an asset. It adds value. But note it's less than what's booked to the balance sheet. The market is discounting the R&D on average because it's risk. And we understand that price is the present value of the future cash flows from the assets discounted by the risk. And the higher the risk, the lower the price. And so the market discounts this. It only gives its values at 0.65. If you go to R&D, advertising, and SG&A, it turns out the coefficient is very much like it's a matched expense. And most advertising, it turns out to be, generating current revenues, not future revenues. There's more work to be done here to look at special situations where you can actually discriminate when the SG&A, the investment, is for future or whether for current expenses. This can be expanded on. But at least for R&D, you see that the market discounts for the risk. Okay. What you accountants are doing is appropriate. Don't treat a dollar of I the same as a dollar of R&D on the balance sheet. They have different pricing implications, and the pricing implications are due to the differences in the risk. A second paper is a paper by Oswald, Simpson, and Zarowan. Oswald, I believe, is at London School of Economics. Not sure about Simpson. Zarowan is at NYU, New York University. And they've just written a very recent paper on R&D under IFRS. And they find that they categorize R&D into investments where have been deemed as successful and move to the D phase, okay, for those that have not yet demonstrated to be successful. And they find that the former, that is those that have been deemed successful, are priced with a premium of 2% over the R investment not yet deemed successful. That is, once you become a successful, there's a revision in the discount rate. And they're priced higher because of the revision in the discount rate. So there are two empirical studies, which all I have time to refer to you. As I said, if you want more empirical validations, there are others of my papers that you can go to see that empirical documentation. That's about the contemporaneous pricing of the risk, okay? And now what I have on the screen is actually results from regressions, where the return on the left-hand side is not the contemporaneous return, but the future return, T+1. And what we do here, what I do here is in this paper here, again with Charles Jung at Berkeley, says, listen, if you ask what investment on the balance sheet, an investment on the balance sheet here, investment here is investment on the balance sheet, what it implies for future returns, the coefficient actually is negative. Okay, that's well understood. Well known, not understood, well known. But why is it negative? Actually, under accounting principles, when investment goes on the balance sheet, it's a realization principle. Firms have investment opportunities, and when they realize those investment opportunities and actually build the plant, that's a resolution of uncertainty that lowers the expected return or the required return. However, if you go to investment expense of the income statement, it has a positive coefficient. That is, it is priced as if it's going to be higher risk. You get on average higher returns for that investment. And so I'll end up, we can go to Q&A. Accounting under uncertainty conveys risk to investors. Fair value accounting, you might say, destroys this. Okay. And in doing so, we're satisfying the investment, the objectives for the of the IASB and FASB of not just providing information about the amount and timing, but also the uncertainty of future cash flows. So, just I don't want to. I'm running over time, but there's three examples here I want to refer to. I've sent this presentation out to you, and it's available if you want it. Here's an example: Twitter. It goes IPO in November 2013. It's hardly ever reported a profit, just losses. If you go to the income statement, you'll see that actually advertising, R&D, and promotion are 80% of revenue. Why is it putting losses? Because it's investing heavily in the future. Not because it's not earning revenues from current customers, earnings from current customers, but it's investing in the future. That's telling you this is a risky company. Is that going to pay off? We start to worry about that because it's been around since 2013 and yet we've yet to see a payoff. The current return on equity is minus 15%. Facebook exactly the same. IPO 4%. Huge expenses. Software is expense. Now there's a big software problem. There's a big charge. It becomes successful. And of course, as you become a successor, you get the earnings. And the ROE increases from 4% to 23.6% currently. Amazon. It started in 1992. Almost every year until 2015, it reported losses. Why? Because this Moses guy every year is investing something new. If it's not movie streaming, it's film production, it's developing drones, the software for drones to deliver your toothpaste through your bedroom window, okay? He's expensing all the time, and that's created losses. He's now becoming profitable, largely, it turns out, from the cloud services, but you see it working there. Buying Amazon is really risky. Are these things going to pay off? So I finished there. Thank you for your attention. Sorry for going a little over, but I can stay a little longer, as long as you wish, for Q&A. So it's over to you. I look forward to your questions.
Okay, thank you, Prof. So we have some question here. So let me read. There are some questions, but I have to choose. So how could we explain about conservatism, or some people say as a prudence principle, when we recognize this uncertainty in advance? So as you say, we mismatch now than later. So how do we reconcile this with a spirit to be neutral? So
Okay, well, it's a good question because there's a sort of historical aspect to this. If you go back to the conceptual framework, conceptual documents of the FASB and the ISB earlier on, going back into the 90s and the early 2000s, they define conservatism as a prudent reaction to uncertainty, okay? Being prudent in the presence of uncertainty. And I think you can talk about prudence and uncertainty almost as equivalent words. And that was the position in the presence of uncertainty. You're pretty prudent, okay? That, of course, says I'm going to bias things downwards. Now, the ISB, particularly during the time when David Tweedy was the chair, don't get me wrong, he's a very good accountant, said, look, this is bias, and we can't have bias in the accounting. Mm-hmm. That is, if you write down, for example, if you keep assets off the balance sheet or you write down assets, you should be able to write them up also. That's unbiased accounting. You just can't write down assets, keep them, you should be able to write them up. And that was the origin of the doctrine and the principle in the conceptual framework now of taking out prudence and conservatism and actually bringing in neutrality. Okay, no bias. What I'm saying here is bias sounds bad and neutrality sounds good, but actually there is method in the madness. Bias is the deliberate, prudent reaction to uncertainty which conveys information. If you have unbiased and you say, look, I'm going to actually write assets up, recognize fair values in the balance sheet, you lose that information. So in my view, that departure from conservatism and prudence as a matter of a qualitative characteristic underlying financial reporting was a mistake. Okay. And that neutrality, yes, we want neutrality. We want to make sure that there's not bias as a general concept. But in terms of recognizing assets, I believe there is an informational role for prudence and conservatism. And that the 1920s experience again is yes, we wrote up assets. We are unbiased in the 1920s before my time. And we wrote up assets. We put water in the balance sheet. They crashed. We put water on the balance sheet with fair value of mortgages in 2007. It crashed. And we had a global financial crisis. I think it's very, very dangerous to say that you want to be unbiased in terms of asset write-ups and that downside. Accountants, let's be prudent. Let's not pretend we have the earnings until we get the customers.
Okay. So let's move to the next question. If you don't mind, please stop the share screen because I need to share the question.
Yeah, sure. Mm-hmm. There you go. You're right. Yep.
Okay. So a very long question from my colleague from Central Java, I think. So this is the question, just curious about the statement that you made regarding risk and versus uncertainty, or can we say perhaps probabilistic versus non-probabilistic uncertainty? And is it possible that earlier conventional accounting theory was developed under risk, and thus we have witnessed that some very conclusive empirical evidence compared to recent findings, which tend to be inconclusive and mixed? And you also mentioned the use of prospect theory to justify from this base decision based on how the entities perceive loss gain domain? Is it possible to apply expected utility theory when firms are faced with low uncertainty? I think it's quite theoretical, this question. So please, Prof.
Yes, it's actually a very insightful question. I passed over this distinction between risk and uncertainty, saying I didn't want to raise that issue here, but now it's raised, and it's a good point to raise. In finance, in the financial economics, we talk about risk. All our asset pricing models, all our pricing models, at least under rational asset pricing, which may or may not include prospect theory, we talk about risk. Under risk, we assume we know the outcome space, the state space. That is what all the likely outcomes are. And we know the probabilities to assign to each of those. There's a little discussion on how this changes when you have objective versus subjective probabilities. But actually, let's put it simply, we know the probability distribution. And the capital asset pricing model starts from the fact that we assume that the probability distribution is a normal distribution, which of course it's not. Now that is an assumption requiring a lot of rationality. I find going through life that I'm always continually surprised by events that occur, of which I had no idea that they were in the state space, in the outcome space. These black swan events in the tales of the distributed, things that just turn up that there's no such thing as a black swan. Well, it turns out when the Europeans went to Australia, they found there were black swans. Did I ever think that the World Trade Center would collapse? No, that's uncertainty. We don't know this characterization. And I think uncertainty is appropriate representation of what we are. Now, I congratulate the accountants for historically always talking about uncertainty, whereas in financial economics, we talk about risk, and we can only do our modeling with risk. That's not quite true. Some people try to handle uncertainty. So, but let's be sure, I think in reality, we're dealing with uncertainty. And so what do you do under uncertainty? Well, I haven't really studied it. I'm not a behavioral economist, but I think what we do, as I understand it, we learn from history, okay, that we don't know these events. So we don't have probabilities. We don't think of probabilistic. We think of non-probabilistic, but we understand these things can happen. So we have these rules of thumb to be prudent. I think the idea of prudence is an thing is I can't characterize, hey, the probability that the R&D is going to pay off is 5% or 95%. Okay, no hope. Maybe if I'm a Ph.D. in biochemistry, I might understand a little better. But it's uncertain. So let's have a basic rule of thumb. Just let's be, in the face of uncertainty, let's be prudent. And that's the accountant's reaction. I think that possibly in research, there's possibly more to explore here, how we actually think about bring in behavioral economics, which deal with uncertainty, prospect theory perhaps, to this issue. But I think that you work with broad rules. Let's be prudent. If we're not sure, let's expense the investment now. Okay, so that's the extent of my thinking. But I must say it's not mature thinking. Okay, there's a lot to be thought out here. But I do think we are right in the calendar talking about uncertainty rather than risk.
Yes. Okay. So next, is it about now it's about earnings management. So because uncertainty is inevitable, then how to manage this uncertainty, how to report this uncertainty may have a connection with earnings management. So by reporting the uncertainty now, by recognizing, by expensing that uncertainty now, do you think will open a opportunity or chance to do earnings management by like putting everything now in the first period of the business, and then so it will lead to next earnings management? What do you think?
Yeah, another good question. As I talk here, I was talking about principles. I'm talking about principles of sort of good accounting. Okay. Now, as with any accounting, we've got to look at the possibility it opens up gaming, which we might call earnings management. Okay. Almost every accounting principle, there are estimates involved. Every accrual accounting principle has estimates involved. They're open to gaming, and that's what we've got to think of. This is, I'm thinking here of an ideal accounting with no gaming. Now, if in fact it's open to gaming, we may have to change the way we do things or build in protections. So we do have protections. For example, we, I must say, on this, on the accounting rules, where for capitalizing R or D, for example, we talk about probabilities, probability of future outcomes. I think that's a very loose, a very uncertain criterion, very fuzzy criterion, open to manipulation. You'll notice the Barker and Penman one is much more concrete. Okay. There's actually a threshold that you have to show me that you've got a good amortization schedule. We do have auditors who are supposed to check on these things, okay? But that's an issue. So it's open to the extent to which is can be gaming, and we understand earnings management destroys the information, or can destroy the information, okay? So I think that goes along with any accounting. Now, I'm told by the Europeans that under IFRS, R is expense, but development is capitalized. But most firms expense the whole lot, okay, because they're so uncertain, okay. The threshold is not very clear. They expense the whole lot. And in practice, it doesn't make any difference. They could go the other way, and be aggressive and actually capitalize more than they should to give themselves higher earnings. That's also in play also, which says, look, when we do this, we need to have more sound operational criteria to actually determine that. And I think the Barker and Penman criteria is getting close to operational, which an auditor can actually audit. But that earnings management always remains in the background.
Okay. I mean, earnings management is also inevitable, like uncertainty.
Yes, that's right. Yes, and no, and there is. It's also integrity of our institutions. Is the auditing profession? Do they have integrity and discipline and forcefulness? Are our regulators, our government regulators, on the job? I think all those things. Are the shareholders on the job in terms of monitoring matter? Is the audit committee on the board? Is the chairman of the audit committee really aware of this? Are pressing to ask these questions? What's going on here? Those institutions are all very important.
Yeah. Okay. Okay, thanks. Then next, with a balanced approach, we are expected to reduce uncertainty, but uncertainty is inevitable. So to what extent is uncertainty allowed in balance sheet? So if we make percentage, for example, how many percent that we can, okay, this one will be recognized as an asset, but that one will be just expense on income statement. So do we have clear cutoff for this?
Well, I think the Barker and Penman paper is an idea to get some sort of clear cutoff, okay? To do that, to establish a threshold for capitalization. But no, it's not the question of actually reducing the uncertainty. I think uncertainty is just in the nature of the of the business. Okay, that's out there.
Yeah.
Okay, you're investing
Yeah.
R&D. It's uncertain. It's a question of accountant providing information about uncertainty. Okay. That I think is an important thing. That information is important because it conveys to investors. Listen, we're not going to pretend you have income now when you don't have it. You're going to have an impairment. Okay, it's up to you to handle uncertainty by hedging, portfolio allocations, and so on. We're here to to extent we can within our double entry system tell you about the uncertainty. Now, I should mention that there's no insistence here. The double entry system can, in fact, give you all the information here. There's a lot of information about uncertainty that can be through additional disclosures. Okay. We're investing in a drug to deal with pancreatic cancer. That's a heck of a problem. Okay. And so the footnotes should be able to tell you, hey, the degree of uncertainty.
Okay. Yeah. Related to the example that you showed, the last three examples, it shows that these three companies invested a lot in their early years, and then they report losses for many years. But how to convince stockholders, the current stockholders, that this will be okay, because in the future the investor will price this investment, this expense or this loss. So do you think it's still okay to report that loss for a long time?
I do. I think until you get customers and start making money from customers. No, it's there are other vehicles, of course, to provide expectations. The management discussion analysis, you would hope your management would be optimistic. We're doing this R&D because we think there's a good chance that we're going to get customers. But I think it comes down to the role of accounting. Management speculate. They probably very often they're biased. Very often they're biased, not because they're intrinsically biased, but because you want your management to be optimistic about what they're doing. They're naturally optimistic. I've got a strategy here I think is worthwhile, and you want that conveyed. But it's free for investors to speculate about it. The accounting says we're a check on the speculation. Okay, that's a very firm doctrine in fundamental investing in accounting. You want the accounting to challenge the speculation, okay, not to reinforce it. Fair value accounting reinforces it, okay. But you want your accounting to be a check on that. Yes, you're free, and maybe you're right in expecting Twitter, when it goes public, to be worth billions and billions of dollars, okay. But we got to tell you that the moment they're not making money, okay, and they're investing in uncertain investments, you might want to take that into account. And my experience during the late 90s with the as an investor with the internet and telecom bubble, so many firms came on. There was huge speculation for those who were around at the time. People telling you, the whole world's changed. It's a new age. It's a whole different investment. It's a whole, you've got to buy Cisco at any price. Okay. Well, Cisco actually was successful, but for me, I saw a firm reporting losses for 1, 2, 3, investing in R&D, not getting customers. Okay. Well, that told me something. Maybe I don't want to invest in that firm. Or if I do, it's risky.
Okay, I think we come to the end. It's already 8:30 now in Indonesia. Especially because we have 3 time zones, so we are in GMT +7. So we're already 8:30, and a committee will take a picture of this Zoom screen and post it on that social media. So Who will do this? Pak Sabar, who do the picture taking?
All right.
So I think it's deep analysis and deep thinking from Professor Penman to make it clear that incorporating uncertainty into framework is inevitable because uncertainty is also inevitable. But how do we treat this uncertainty will determine whether investor appreciate our information or not. So based on the paper, we can see that if we report the uncertainty now, if we expand the uncertain investment now, it will earn future return. Okay, so after this, Prof. Penman, you are in fact invited to meet with head of department on the breakout room. So you may click the breakout rooms and join the meeting there with head of department, Bu Bibi, and also Bu Nadia, please. So, yeah.
Yeah, you should tell me how to get to a breakout room. I've not done that. Oh, here we are, breakout rooms. There we go.
Breakout room, yeah. Okay. So just click that and is it there?
Yeah, it says, do I pick create? Do I?
Oh my God! So maybe the committee is not prepared yet. So please, Pak Sabar, prepare the breakout room now.
Okay, okay. All right, prepare yourself.
Okay, then while waiting for the breakout room preparation, for the audience, for the participants, we would like to invite you to fill up the questionnaire to give us your feedback for this lecture. So the evaluation form will be posted on the chat room. Is it not ready, Pak Sabar? The breakout room.
Okay, a few seconds. Nothing.
Okay.
It's being prepared.
And also, let me okay, this one. Let me inform you that we're gonna have another guest lecture next 31st May on Monday with Professor Victor Mas, and we're gonna talk about management accounting, and it will be very interesting. So mark your calendar and register soon. The registration link is there, and you can also get the information from the Department of Accountancy, social media. We have Twitter, we have Instagram. Now, Professor, now we have everything. The social media it's more powerful. We have also YouTube channel. So you are now in YouTube. So you can, you can see it anytime. So Pak Sabar, is it done?
Okay. Oh, it's not yet. It's not ready yet.
Okay, let me prepare then.
Probably while we are waiting for the breakout room, I think probably we can take a picture again. So please
Okay.
Yeah, for those who might not open their picture profile, so please do open your picture so that we can take a good picture for all of us.
So turn on the video. We can see your face.
All right. 1, 2, go for the first one. Move to the second. Not yet. 1, 2, 3. Alright, move to the third screen. Do 4, 1.
How many screens do you have?
I think I have 6.
Okay, you have 6, so you
Yeah,
have
it's
to take
almost
all the 6.
yeah, it's almost done.
I wanna be
Okay.
a millionaire, so breaking bad.
Okay, it's done.
Okay, so I think there is a room, there is a breakout room called department meeting. If you can see, Prof, can you see it? The department room?
No, it still just says create.
Oh, so let me check. Still create. I have to assign you.
Oh, okay.
Assign. Okay, can you check again? Breakout room, department meeting.
No, it says create breakout rooms.
Oh,
That's what it says. Mhm.
still same. Sometimes it's out of control. I don't know. Okay. There is a
There it is.
invitation. Yeah. So please join the breakout room. Yeah. So for the audience, for the rest of the audience, thank you for your participation. Thank you for your attendance here, and see you next on the guest lecture. And stay healthy, stay safety, and good night. Assalamualaikum warahmatullahi wabarakatuh.